Welcome back to the COO's office. In our last meeting, we opened the hood of the car. We learned how to read the financial statements, the income statement, the balance sheet, and the cash flow statement. We learned how to check if the engine is running and if there is fuel in the tank. Let's say you found a company that looks fantastic. Sales are growing, debt is low, and cash is flowing like a river. It is a perfect machine. So, do you buy it? Not yet. Imagine you are buying a used car. You find a pristine, perfect condition Toyota Camry. It runs perfectly. But the seller looks at you and says, "The price is $1 million. Do you buy it?" Of course not. Why? Because even though the quality is good, the price is wrong. A good company can be a terrible investment if you pay too much for it. As the COO of You Inc., your job is not just to find good merchandise. It is to find good merchandise at a bargain price. Today we are going to master the art of valuation. We are going to discuss per PBR and ROE, mastering essential ratios. These three acronyms are the GPS coordinates of the stock market. They tell you exactly where you are and if you are paying a fair price. Let's start with the most famous one, PER, price-to-earnings ratio. The PE ratio answers a simple question. How many years will it take for me to earn back my investment through the company's profits? Here is the formula. Current stock price divided by earnings per share. Let's use an analogy. Imagine you want to buy a small neighborhood coffee shop. The owner tells you, this shop makes $100,000 of pure profit every year. If the owner asks you to pay $1 million to buy the shop, what is the PER? $1 million divided by $100,000 equals 10. The PER is 10. This means if profits stay the same, it will take you 10 years to make your money back. Now, imagine the owner asks for $5 million. Now, the PER is 50. It will take 50 years to break even. That is expensive. In the stock market, the average PER historically hovers around 15 to 20. If you see a stock with a PER of 5, it might be incredibly cheap. It's a bargain bin sale. If you see a stock with a PER of 100, it is priced for perfection. The market expects that company to grow explosively. If it doesn't, the stock will crash. So, rule number 1, the lower the PER, the cheaper the stock relative to its profit. Now, let's move to the second metric, PBR, price-to-book ratio. The PE ratio looks at profit. The PB ratio looks at assets. It answers the question if this company went bankrupt today and sold everything, every factory, every desk, every patent, how much money would be left compared to the stock price? Here is the formula. Market capitalization divided by book value net assets. Let's go back to the coffee shop. The shop has coffee machines, tables, and a building worth $500,000 in total. If you can buy the shop for $500,000, the PBR is 1.0. You are paying exactly what the hard assets are worth. If you can buy the shop for $250,000, the PBR is 0.5. You are buying dollar bills for 50 cents. This is the dream of value investors, buying a company for less than its liquidation value. However, be careful. In the modern world, tech companies like Google or Facebook have very few physical assets. Their value is in their code and their brand. So, for tech companies, PBR is often very high, and that is okay. But for banks or manufacturing companies, a low PBR is a critical sign of value. So, rule number 2, a PBR below 1.0 means you are buying the assets at a discount. Now, we come to the third and perhaps most important metric. This is Warren Buffett's favorite number. ROE, return on equity. PER and PBR tell you if the stock is cheap. ROE tells you if the management is competent. It answers the question, how efficiently is this company using the shareholders' money to generate profit? Let's imagine you have two chefs, Chef A and Chef B. You give each of them $100 to buy ingredients. Chef A takes your $100 and cooks a meal that sells for $110. He made $10 profit. His ROE is 10%. Chef B takes your $100 and cooks a meal that sells for $130. She made $30 profit. Her ROE is 30%. Who is the better chef? Chef B. She is 3 times more efficient with your capital. In the business world, a company with a high ROE is a compound interest machine. It means the management knows how to squeeze every drop of profit out of the money they have. Generally, an ROE consistently above 15% indicates a wonderful business. With a strong competitive advantage, an ROE below 5% suggests a zombie company that doesn't know what to do with its cash. So, rule number 3, high ROE means high efficiency. Now, how does the COO of You Inc. combine these 3 tools? We are looking for the holy grail. We want a company with low PER, it is cheap relative to earnings. Low PBR, it is safe relative to assets. High ROE, it is highly efficient at making money. If you find a stock with a PER of 8, a PBR of 0.8, and an RO of 20%, you should get very excited. You have likely found a mispriced diamond. However, the market is smart. These diamonds are rare. Usually you have to trade off. High-growth companies usually have high purse. Safe companies usually have low ROEs. Your job is to balance the scale. If you pay a high PER, make sure the ROE justifies it. If the ROE is low, make sure the PBR is cheap enough to offer safety. We have now learned how to check the engine financial statements and how to check the price tag per PBR ROE. You are becoming a sophisticated buyer, but there is one final layer to the analysis. You can have a great engine and a great price. But what if your coffee shop opens and next week a Starbucks opens right next door? What if your profits get stolen by a competitor? You need a defense system. You need a wall around your castle. In investing, we call this an economic moat. In the next episode, we are going to discuss how to find companies that are impossible to kill. We will talk about finding companies with economic moats. We will learn why Coca-Cola stays on top for 100 years, and why other companies fade away. Calculate your ratios. Check the price. I'll see you in the next video.